Tuesday, January 25th meeting of the Santa Barbara City Council Finance Committee will please come to order. I will begin by asking if there are any members of the public who wish to comment on items not on the agenda. Seeing none, we will go to our first item, Mr. Samario.
Thank you, Mr. Chair, members of the committee. Bob Samario, Finance Director. We're here to present to you the investment report for the quarter ended December 31st, 2010. And we have Jill Tarr, our Treasury Manager, who will be presenting the report today. So I'll turn it over to her.
Thank you, Ms. Tarra.
Thank you. Good afternoon, Chair Francisco and committee members. Welcome, Committee Member White. I'm here today to present, as Bob indicated, the quarterly investment report and fiscal agent report for December 31st, 2010. As a quarter-end report, I'll briefly walk through some of the key economic events over the quarter, discuss the city's investment activity during the quarter, and then we'll talk a little bit about some performance measures related to the yield and the composition on the portfolio today. Over the last 12 months, financial markets posted gains as the economy continued to stabilize, and we apparently avoided a double-dip recession. All three of the major market indices posted gains, including Dow Jones, which was up over 14%. Also, the S&P 500 and NASDAQ posted gains in response to strong corporate earnings and also investor confidence. So that was good news. Last quarter, the Fed provided additional support to the economy, as it indicated it would in its September Federal Reserve open market meeting, to provide additional support to the economy through its quantitative easing strategy, which I'm sure you've heard of as QE2, when it began purchasing $600 billion in Treasury, thereby increasing the money supply in the economy. Doing this, they're trying to keep interest rates low, spur growth, and also return the inflation rate to its target level or target range of 1.5% to 2%. And this is in response to real fears both at the government and the analysts, national economic analyst level, of fears of deflation. So we seem to have avoided that for now. Although still at very low levels, CPI was up roughly 0.5% in December, and national unemployment remained very high at 9.4%, which was down just slightly from the September quarter of 9.6%. Bob, if you can go ahead and put the Treasury yields overhead up. This table is shown also on page 2 of the Councilor Agenda report for the investments. As you can see, over the quarter, particularly farther out on the yield curve, which means with a longer maturity, Treasury yields increased, again due to strong corporate earnings over the quarter and improved investor confidence. As investors reduced their demand of Treasuries and hopped more into the financial markets, it drove the prices down on the yields, or drove the prices down on the securities, Treasury securities themselves, and therefore driving up the yields. You can see that in the 3-month and 6-month T-bill, they remained basically unchanged at down just slightly by 1 or 2 basis points. And the 1 year also remained roughly unchanged, up just 1 basis point from where it was at the end of the September quarter. The 5-year Treasury was up 75 basis points. So we saw a steepening of the curve, meaning the longer you go out, the more you're going to earn relative to the money that you invest. And again, this corresponds to improved confidence. Now, we look at these measures, these national economic measures, these financial market results, the Fed funds activity during the quarter, CPI, unemployment, because all of these can affect Treasury rates. And the Treasury yields directly influence how much we earn on our portfolio. So this is a little background on why we go through this every quarter, so you can see what's driving these Treasury yields and then also driving our overall yield on our portfolio. If we turn to the table of investment activity, this also is at the bottom of page 2 on the investment report. You can see that the city invested $26 million during the quarter. The purchases consisted of $20 million in AAA-rated federal agencies callable securities, which have higher yields than non-callable securities. In exchange for this higher yield, there is a risk that if rates turn around, the issuer could call it before its final maturity date. So you do get a premium for that. So we invested $20 million in the callables. We bought $2 million in federal agencies, a farm credit investment, and we also purchased $4 million in corporate notes. Both the agency bullets and the corporate notes will be held to maturity. During the December quarter, you can see down below that $12 million of the federal agencies in the portfolio were called. We also, one of our certificates of deposit held with Montecito Bank and Trust matured for $2 million, and an FHLB bullet matured. The airport department also made its semi-annual principal and interest payment, resulting in a slight paydown of that outstanding note held in the city's portfolio by just a little over $79,000. We'll turn now to the investment yields chart, which shows over time how the city's portfolio yield has performed relative to some other measures that we measure ourselves against. And although the numbers are a little small, I'll walk you through, and the colors aren't extremely bright. But the top line represents the yield, or how much we're earning on the city's portfolio. That's the red line. The next line down is the green line, and that shows the LAIF rate, which is the rate we earn at the state's pooled money market account where we invest our idle cash that's not actively invested in any corporate notes or federal agencies or treasuries. So we hold our cash that's available for our daily operations, and we can send it up any day by 10 a.m. or pull it down any day by 10 a.m. So it's our daily one day to maturity investment. LAIF stands for the Local Agency Investment Fund. And again, that's the state of California's pooled money market fund that we invest our cash in, rather than holding it at a bank earning a far lower rate of interest. The next line down, the brown line, shows the 2-year Treasury note, and we use that as a benchmark because it corresponds roughly to our target length of maturity on the portfolio, which is 2 to 2.5 years. So we compare ourselves to that benchmark. And the bottom line, the blue line, is the 90-day T-bill. And we use that rate as a benchmark because that would be a LAIF alternative rather than leaving it in the bank if we invested our short-term funds in 90-day T-bills versus the LAIF rate. So that's a little bit of the background on how we compare ourselves. Now, if you go back to December 2007, and the National Economic Bureau of Research determined that the December 2007 was the quarter when the recession officially started. So you can see at the start of the recession, our city's portfolio, the top line, was earning just over 5%, and just roughly in line with what the LAIF portfolio was earning, which was 4.97. And in normal times, that's typically what we see. The city's portfolio will hover within a 1% band of the LAIF rate, either within 1% above or 1% below. So that's right on target, and certainly outperforming the 90-day T-bill and the 2-year Treasury. Now, once the recession hit, you can see that all three of the benchmarks that we measure ourselves against just took steep dives and continued to take dives until they bottomed out in 2009. The city's portfolio declined. It declined far less quickly and far less than the other measures for a couple of reasons. One being that we hold longer-term investments than any of that, which mitigates the impact on our portfolio. And we also changed our investment strategy just a bit by bumping up the callable percentage so that we mitigated the low interest rate. We also didn't rebuy or repurchase any treasuries in our portfolio, given that the federal agencies, the Fannie Mae's and the Freddie Mac's, the federal government gave their full explicit backing of those, and therefore they became just as safe as treasuries. So we, for the time, all while maintaining our two primary investment objectives, which are the safety and liquidity of the portfolio. So once we've ensured the safety of the investment and that we have enough cash on hand to meet our daily operations, then we turn to this yield, and certainly in this declining interest rate environment, tried to take some measures to offset the declines. With that said, our investment yields have gone down roughly 3%, but that's certainly better than some agencies out there, and certainly better than our other benchmarks. Okay. So the next overhead looks at our portfolio composition, and this will go a little bit more into our adjusted strategy during this recession. You can see that the LAIF has the percentage of the portfolio in LAIF has remained not that far off. We have a little bit less in LAIF, and of course that's certainly a lower earning investment than it would be by buying treasuries, agencies, or corporate notes in this time. As the treasuries that we held in the portfolio matured, we didn't buy back in, as I mentioned before. The federal agencies, which are FHLBs, the Federal Home Loan Bank notes, Federal Farm Credit Bureau notes, Fannie Mae's and Freddie Mac's that we hold, we've bumped that percentage up, and that corresponds roughly to an increase in the callable percentage that we hold in the portfolio from 56.7% of the portfolio in December 2010 to up to almost two-thirds of the portfolio in federal agencies. As you can see, we hold far less corporate notes in the portfolio since we did before the recession hit, and that was due to just general uncertainty about how any company was going to fare through this economy or through the recession. And in light of that, and without having a whole team of investment analysts to perform in-depth analysis on all companies that we would potentially buy their notes, we just said for now we're not going to buy corporate notes. And certainly this last quarter we did repurchase 2 corporate notes of some of them that have matured. We bought a GE and also a Berkshire Hathaway, and we feel confident that with the highly rated stable outlook companies that's a good way to proceed at this point, sort of as we return slowly to normal times. The certificates of deposit held in the portfolio remained roughly the same, and as you can see, since the recession hit, the council approved the purchase of the airport promissory note for the construction of the quick turnaround facility, and we're earning 7% on that investment, so that's been a nice investment. So one thing I'd like to clarify on the agencies, and it's just a little bit of clarification on bullet versus callable, and you'll hear me use those terms. A bullet is a federal agency note that we buy that is held to maturity, so it'll have a final maturity date. As a callable, will have a final maturity date, but according to a schedule, whether it's quarterly or perpetual or one-time call, the issuer has the ability to call that maturity or else repurchase it back before the final maturity in the event that interest rates should turn around. So, and of course, in exchange for that risk of how long you're going to hold it, you get a higher interest rate. Okay. With that, we'll just summarize the investment income over the quarter. You can see on the pooled investment portion of the portfolio, the interest for the quarter totaled $766,355, combination of interest, amortization, and also a little bit of interest on the small cash balance we hold in the bank account at Santa Barbara Bank and Trust for our operations. Investment on the LAIF holdings that the RDA has up at LAIF. The LAIF money market account totaled $17,465, and total interest for the quarter was $783,820. Lastly, I'll just summarize for you so you get a sense of the scale and the amount of the holdings in the portfolio. The amount held at LAIF for both the city and the RDA portfolios at the end of December was $41.5 million. We have one certificate of deposit remaining in the portfolio that for $2 million that's held at Montecito Bank and Trust. The federal agency issues held in the portfolio, the book value is $104.8 million, and our corporate notes are just under $8 million for a total invested amount of cash at $156.3 million. We also have the Santa Barbara Airport promissory note that I mentioned earlier at the balance of just over $6 million, and a small amount of cash at the end of December for $4 million. Total portfolio equals $166.4 million. As you can see, the second column or the third column over shows the yield to maturity on the overall portfolio was 2.075 at the end of December, and the average days to maturity of the investments, the outside investments, is 778 days and 1,000 days if you factor in that 20-year, the remaining time on the 20-year promissory note. So I thank you for your time. I went into a little bit more detail since I was the only
Excellent.
item on the agenda.
If I could just want to add one thing, because we get this question a lot. The $166 million is a citywide number, so it's money that we pool across all funds and we invest in together. We don't invest enterprise funds separately or specific fund assets separately. We take it all together, and so this is allocated among all the funds citywide. And the general funds portion of that is a very small portion, it's somewhere in the neighborhood of $10 to $50 million. But again, it's not a general fund number alone; it's a citywide number.
Okay. Questions from committee members? Mr. White?
Thank you. Well, first of all, is the airport promissory note, is that callable? Do they have the ability to call that?
They do have the ability to pay it at any time. So in that sense, it is callable to prepay it before the final maturity in 19 years, or I think there's 18 and a half years left.
So don't they have a bond is it a bond that they've floated to pay for the terminal? What's
Originally, this piece, which is a private enterprise, was going to be wrapped with the bond issue, which was the public portion or the municipal portion of the bond issue. And because of the rate environment or the bond market at the time, it made most financial sense to break those two separate bond issues apart and just issue bonds for the construction of the terminal itself. And then the city's portfolio loaned the $7.8 million, I think was the original loan, to the airport to do the quick turnaround facility.
and quick turnaround?
It's the rental car facility,
Okay.
which
The one
is
that's up now and
the
running?
one that's up and running now.
All
And
right.
so the proceeds from that repay this note. So I wouldn't anticipate that they'd prepay that, but you never know.
And then Mr. Samario mentioned the money in the general fund. There's the disaster reserve fund, and that's roughly $15 million. Is that right? And then the rainy day reserves are just about done, but we have a little bit of money in that at this point.
Mr. Chair and Committee Member White, yes, there is about $18 million in total, the general fund in reserves, which approximate, but not exactly because they're not one-to-one related, but it approximates the amount of cash that the general fund has. And it's about $15 or $16 million for the disaster reserve, about $1.5 million, maybe $2 million in the budgetary reserve or rainy day fund. And then there's $1 million for capital. So I think in total it's somewhere around $18 or $19 million that the general fund has in reserves.
Great. Thank you.
And if I might add on that a bit, those reserves are calculated at a particular point in time once a year. So by December 31st, we did receive our big property tax payment, which can cause some inequities. So the general fund revenues and some of the other fund revenues are seasonal. So those reserve balances may go a little bit earlier in the first half of the fiscal year and then return to that sort of steady level. But certainly at December 31st, that's what Bob said holds in terms of seasonality of our revenues and how that affects the actual reserve balance each month.
Mrs. Self? No? Very good. Is there another report, the fiscal agent report, separate or?
It's the fiscal agent schedule is shown on the last page of the investment report, and that just shows the balances held with the trustee, which are largely the unspent project funds
Okay.
for debt issues that the various city funds have issued. So there's no separate
Okay.
report on that,
Fine.
and those funds are managed by the third-party trustees, and so we simply account for them and make sure that they're managing them properly, and they're there.
Very good. Okay. Could I have a motion to accept the quarter-end report for quarter ending December 31st, 2010?
So move.
Second?
All those in favor?
Aye.
We are adjourned.